Welcome to today's silver market update for Saturday, December 28, 2025. In this educational presentation, we'll examine what has been one of the most extraordinary periods in silver market history, analyze the unprecedented price movements we're witnessing, explore the technical picture at all-time highs, and discuss the fundamental factors driving silver's historic rally as we approach the end of what will be remembered as a landmark year for precious metals. Silver is experiencing a historic bull market that few analysts predicted would unfold with such intensity. The metal that serves dual roles as both a monetary asset and an industrial commodity is now trading at levels that have shattered all previous records, reflecting profound changes in global supply dynamics, geopolitical tensions, and industrial demand patterns. As of the latest trading data, silver has reached unprecedented territory, with spot prices touching the $76 to $79 range per ounce. To put this in perspective, silver has surged approximately 150 to 169% year-to-date in 2025, marking one of the most explosive rallies in the metal's modern trading history. These are not modest gains in a quiet consolidation pattern, but rather a historic revaluation that has caught the attention of investors, industrial consumers, and policymakers worldwide. The precious metals complex as a whole is experiencing an extraordinary moment. Gold has simultaneously reached all-time highs above $4,500 per ounce, up over 70% this year, representing its largest annual gain since 1979. This synchronized surge across precious metals reflects deep underlying shifts in global financial markets, monetary policy, and geopolitical stability. What makes this period particularly significant is the confluence of structural supply constraints, escalating geopolitical tensions, and policy decisions by major commodity-producing nations that are fundamentally reshaping the silver market. This is not simply a speculative rally driven by momentum traders, but rather a repricing event driven by genuine supply-demand imbalances and strategic considerations by nation-states. The single most significant development affecting the silver market is China's implementation of comprehensive export controls on silver, set to take effect on January 1, 2026, just days from now. This policy shift represents a fundamental change in global silver supply dynamics and cannot be overstated in its importance. China controls an estimated 60 to 70% of global silver refining capacity, making it the dominant gatekeeper for newly mined silver entering the world market. Under the new regulatory structure, Chinese exporters will be required to obtain government approval for silver shipments, with restrictions extending through 2027 at minimum. Only entities meeting a minimum annual production threshold of 80 tons will qualify, effectively consolidating export privileges among state-aligned companies while excluding smaller players. This departure from market-driven allocation signals China's recognition of silver as a strategic resource. The policy mirrors China's earlier export controls on rare earth elements, where quotas steadily tightened over multi-year periods, ultimately reshaping global supply chains. Market analysts familiar with Chinese commodity policy suggest this is not a temporary measure, but a long-term strategic repositioning. The timing is particularly significant because the global silver market has been in a structural supply deficit for 5 consecutive years. Despite annual shortfalls documented by industry research organizations, silver prices remained relatively suppressed through Chinese supply injections into global markets. The termination of this support mechanism has immediately triggered supply concerns in major trading centers, including London and Shanghai, where physical inventory withdrawals accelerated dramatically throughout late 2025. If China reduces silver exports by 50%, as some analysts project, global silver deficits could exceed 5,000 metric tons annually. This supply-demand imbalance occurs precisely as industrial demand accelerates through renewable energy infrastructure, build-outs, and electronics manufacturing expansion worldwide. Silver's technical picture reflects a market in price discovery mode at all-time highs. The metal recently touched $78.65 per ounce, obliterating the previous records and entering uncharted territory where there are no historical resistance levels to reference. From a technical perspective, silver has broken out of multi-decade consolidation patterns. The ascending triangle formation that developed over recent months showed a decisive breakout above the previous resistance near $4,237, with projected targets extending well above current levels based on measured move calculations. The 50-day and 200-day moving averages, which technical traders watch closely, are in strongly bullish alignment with both trending steeply upward. This configuration typically indicates sustained momentum rather than a short-term spike. The moving averages have served as dynamic support on any pullbacks, with buyers consistently stepping in at these levels. Volume patterns during the rally have been substantial, indicating genuine conviction behind the move rather than thin, low-volume price action that might characterize a false breakout. However, the holiday period has resulted in somewhat thinner liquidity than normal, which can contribute to elevated volatility in both directions. The Relative Strength Index has spent considerable time in overbought territory, which is characteristic of strong trending markets. During powerful bull runs, RSI can remain elevated for extended periods, and traditional overbought readings do not necessarily signal an imminent reversal. Rather, they confirm the strength of the underlying trend. Technical analysts are now looking at psychological round numbers as potential short-term targets. The $80 level represents the next major milestone, followed by $100 per ounce, a level that seemed unthinkable to many just months ago but is now being discussed as a realistic possibility, given current supply constraints. Support levels, while not tested recently, exist in layers below current prices. The $70 level represents the first significant support, followed by the $65 to $68 zone where previous breakout consolidation occurred. Any pullback to these levels would likely attract strong buying interest from those who missed earlier entry points. The gold-silver ratio currently sits at approximately 65, meaning it takes 65 ounces of silver to purchase 1 ounce of gold. This ratio has compressed somewhat during silver's outperformance, as silver has risen faster than gold on a percentage basis, despite gold's own strong rally. Historically, the gold-silver ratio has averaged between 60 and 65 over very long time periods, suggesting that at current levels, either metal appears dramatically overvalued relative to the other using this particular metric. However, the ratio reached as high as 90 to 100 during periods of extreme stress and has fallen to 40 or below during previous silver bull markets. Some analysts argue that silver's expanding industrial applications, particularly in solar energy and electric vehicles, could support a structurally lower gold-silver ratio going forward. If silver becomes increasingly valued as an indispensable industrial commodity rather than purely a monetary metal, the traditional ratio relationships may shift. During the current rally, silver has demonstrated superior percentage gains compared to gold, suggesting the market is pricing in both monetary factors affecting all precious metals and specific supply constraints unique to silver. This outperformance has led some to characterize the current move as the beginning of a potential silver squeeze, where industrial users compete with investors for limited available supply. The silver market entered 2025 already facing significant supply challenges. Global demand reached approximately 1.24 billion ounces, while supply lagged at roughly 1.01 billion ounces, creating a shortfall of 230 million ounces for the year. These numbers represent a substantial and growing imbalance between consumption and production. Primary silver mining has faced numerous challenges. New discoveries of major silver deposits have been limited in recent years, and the time required to bring new mines online, from exploration through permitting to production, typically spans 7 to 10 years. This means that even if silver prices remain elevated, supply response will be measured in years, not months. Approximately 70% of silver production comes as a byproduct of mining other metals, particularly zinc, lead, copper, and gold. This means silver supply is not entirely responsive to silver prices alone. A copper mine continues operating based on copper economics, producing silver as a secondary product regardless of silver price fluctuations. Inventories at major storage locations have declined dramatically. COMEX registered silver stocks, which represent metal available for delivery against futures contracts, have dropped approximately 70% since 2020. The Shanghai Futures Exchange has seen inventory levels fall to 10-year lows. These drawdowns in visible inventories suggest the physical market is indeed tight, validating the concerns about supply constraints. One particularly notable event occurred around Thanksgiving, when the CME experienced a trading halt attributed to cooling system failures during a period of intense silver price action. Market observers noted that this coincided with significant movements of silver from the registered category to the eligible category within JP Morgan's COMEX warehouse, with 13.4 million ounces transferred in a single day. Some market participants suspect that large Asian longs were seeking to take physical delivery, and the resulting negotiations required time to settle. Silver's industrial applications continue to expand, creating structural demand that operates independently of investment flows. The solar photovoltaic sector has become one of the largest consumers of silver, accounting for approximately 20% of global silver consumption. Each solar panel requires silver for its conductive properties, and there are currently no viable substitutes that match silver's performance characteristics at scale. With global solar installation capacity expanding rapidly as nations pursue renewable energy targets, this represents a multi-year, potentially multi-decade growth trajectory for silver demand. China, Europe, and the United States have all announced ambitious solar deployment goals, and each panel installed represents incremental silver demand. The electric vehicle revolution is another significant demand driver. Each EV battery system and the vehicle's electronic components require substantial amounts of silver for electrical conductivity, with global EV adoption projected to triple by 2030, according to industry forecasts. This sector alone could absorb hundreds of millions of additional ounces of silver annually. The semiconductor and electronics industries remain consistent consumers of silver. The metal's superior electrical conductivity makes it indispensable in various applications, from smartphones to data centers. The expansion of 5G networks and artificial intelligence infrastructure build-outs both require significant silver content in their electronic systems. Medical applications, particularly silver's antimicrobial properties, represent another area of growing demand. Silver ions and nanoparticles are used increasingly in wound care, medical devices, and healthcare applications where infection prevention is critical. The current precious metals rally is occurring against a backdrop of elevated geopolitical tensions that have investors seeking safe haven assets. Several developments are contributing to this dynamic. The United States has implemented what it describes as a blockade on sanctioned Venezuelan oil tankers, deploying significant military assets to the Caribbean. The Coast Guard has intercepted multiple vessels, with some being escorted to Texas for cargo seizure, while others have fled into international waters. These actions represent an unprecedented use of military force in energy markets and have raised concerns about potential escalation. On Christmas Day, December 25, 2025, the United States conducted military strikes against Islamic State targets in northwestern Nigeria. The strikes, which involved Tomahawk missiles and Reaper drones, were carried out in coordination with Nigerian authorities, but represent a significant expansion of U.S. military operations in Africa. This action has added to general geopolitical uncertainty. The ongoing conflict between Russia and Ukraine continues to simmer, with periodic escalations keeping markets on edge. These various geopolitical tensions have reinforced demand for precious metals as portfolio insurance and safe haven assets. Central banks globally have been significant buyers of gold in 2025. adding hundreds of tons to reserves in an apparent effort to diversify away from dollar-denominated assets. While central banks do not typically purchase silver, this trend reflects broader concerns about fiat currency stability and geopolitical tensions that affect the entire precious metals complex. The Federal Reserve cut interest rates by 25 basis points in December 2025, a decision that reduced the opportunity cost of holding non-yielding assets like precious metals. Market participants are pricing in expectations for additional rate cuts in 2026. As inflation appears to be cooling and labor market conditions show signs of softening. Lower interest rates make precious metals relatively more attractive in two ways. First, they reduce borrowing costs for those who might use leverage to purchase metals. Second, and more importantly, they reduce the yields available from competing safe assets like treasury bonds and bank deposits. When risk-free rates fall, the relative attractiveness of gold and silver increases. Real interest rates, which subtract inflation from nominal rates, have remained low or negative in many periods throughout 2025. Negative. Real rates historically correlate with strong precious metals performance, as investors seek to preserve purchasing power against inflation while earning minimal yields in traditional fixed income markets. The US dollar has experienced periods of weakness throughout the year, which typically supports commodity prices, including precious metals. A weaker dollar makes gold and silver less expensive for holders of other currencies, potentially increasing international demand. The physical silver market is showing clear signs of tightness. Premiums on physical products, the amount buyers pay above spot price for actual coins and bars, have risen substantially. These elevated premiums reflect strong retail and institutional demand for physical metal. Combined with constrained supply of finished products, lease rates in London for silver have spiked to 8 to 9%, according to various sources, indicating significant demand to borrow physical metal. High lease rates typically signal that market participants are willing to pay substantial costs to secure silver for immediate delivery, suggesting physical scarcity in key markets. Silver-backed exchange-traded funds have experienced mixed flows, with some seeing outflows while others attract inflows. The world's largest silver ETF, iShares Silver Trust, recently reported holdings declining by 56.41 tons, though total holdings remain substantial at over 16,000 tons. These flows reflect portfolio rebalancing and profit-taking by some holders, even as prices rise. Mint sales data shows robust demand for government-issued silver coins. The U.S. Mint's American Silver, Eagle program, and similar programs in other countries have reported strong sales throughout the year, indicating sustained retail investor interest in physical silver ownership. India, historically a major consumer of silver, has shown aggressive buying patterns. The country imported over 1,700 tons of silver in October alone. And recent policy changes now allow pension funds to allocate to gold and silver funds, albeit at a modest 1% allocation to start. This represents a new source of institutional demand in a country with deep cultural affinity for precious metals. Silver mining companies and producers with significant silver byproduct credits have seen their equity values surge. Major producers, including companies like Newmont and Barrick, experienced stock price appreciation of approximately 90% during late 2025 as investors recognize the favorable economics at current silver prices. Junior and mid-tier mining companies with advanced stage silver projects are particularly well positioned to benefit. Projects that were marginal at $30 silver become highly profitable at $75 silver. And companies with quality deposits are attracting renewed investor interest and capital. However, the supply response from the mining sector will take time. Even with elevated prices providing strong incentives, the lead time from discovery to production remains measured in years. Exploration, permitting, environmental assessments, financing, and construction are all time-consuming processes that cannot be rushed, meaning near-term supply will remain constrained regardless of price signals. some mining executives are cautioning against assuming current prices represent a sustainable long-term baseline for project economics. While they welcome the current environment, conservative companies continue to use lower price assumptions for major capital allocation decisions. Recognizing that commodity markets can be volatile, the Commodity Futures Trading Commission's Commitment of Traders report, which provides insight into positioning in silver futures markets, shows that managed money has become more bullish throughout the rally. Though positioning dynamics are complex given the rapid price movements, market structure analysis reveals concerns about the paper-to-physical ratio in silver markets, with futures and derivatives markets dwarfing available physical supply. Some analysts suggest the market is vulnerable to a short squeeze scenario where those with short positions are unable to deliver physical metal if called upon to do so. The historical short squeeze in October was referenced in recent commentary, with market participants noting that the aftermath of that event saw significant silver flows to London vaults. Though much of the world's available silver reportedly remains in New York due to ongoing uncertainty about U.S. commerce. Department probes into whether critical minerals imports threaten national security, potentially leading to tariffs or trade restrictions. Market forecasts for silver in 2026 vary widely, but many analysts have revised targets upward given current supply dynamics. Some projections suggest silver could trade in the $70 to $80 range through early 2026, while more optimistic forecasts envision scenarios where prices reach $100 or higher if supply constraints intensify. Technical analysts pointing to historical patterns note that silver tends to experience explosive moves during bull markets, with rapid price appreciation followed by consolidation periods. The current rally fits this pattern. Though the fundamental drivers around Chinese export restrictions represent a new element not present in previous bull markets, risk factors that could temper the rally include a significant slowdown in industrial demand if global economic growth disappoints, resolution of geopolitical tensions that have been supporting safe haven demand, or policy reversals by China regarding export controls. Additionally, if prices rise too far too fast, demand destruction could occur as industrial users seek to reduce silver content in products or find substitute materials where possible. Some analysts warn that momentum-driven rallies can reverse sharply when sentiment shifts, particularly if large speculative positions have accumulated. The market's vulnerability to corrections increases when positioning becomes extreme, and when moves are driven more by fear of missing out than by underlying fundamental analysis. However, the supply deficit story appears genuine and persistent. Unless demand falls significantly or new supply sources materialize quickly, both of which seem unlikely in the near term, the structural imbalance supports elevated prices. The China export restrictions added geopolitical dimension to what was already a tight physical market, potentially extending the duration and magnitude of the current bull market. As we move into 2026, the silver market stands at a historic crossroads. The implementation of Chinese export controls on January 1st will provide an important test of how the market functions under constrained supply conditions. Market participants will be watching closely to see whether Chinese authorities grant liberal licensing to exporters, or whether quotas prove restrictive in practice. The trajectory of industrial demand, particularly from solar and EV sectors, will be crucial. If the green energy transition continues at its current pace or accelerates, silver demand could exceed even bullish forecasts. Conversely, any slowdown in these sectors could ease some pressure on the supply-demand balance. Geopolitical developments will remain important. The Venezuela situation, tensions in various regions, and broader U.S.-China relations all have potential to influence safe haven demand for precious metals. Central bank policies and inflation trends will also play key roles in determining investor appetite for precious metals. The physical market's ability to meet delivery demands will be tested. If tightness in London, New York, and Shanghai markets persists or worsens, could lead to further price discovery to the upside as industrial users compete more aggressively for available supply. Seasonal patterns suggest that January and February can be strong months for precious metals, with new investment flows entering markets at the start of the year and Chinese New Year demand adding to physical buying. However, seasonal patterns are merely historical tendencies and do not guarantee outcomes. Silver's rally to all-time highs above $75 per ounce represents far more than a typical commodity bull market. The confluence of structural supply deficits, Chinese export restrictions, explosive industrial demand growth, geopolitical tensions, and accommodative monetary policy has created conditions unlike anything seen in modern silver market history. The market is experiencing a genuine repricing event as participants recognize that silver is becoming an increasingly scarce resource relative to demand. Whether this repricing continues to unfold gradually or accelerates further will depend on how various fundamental factors evolve in coming months. For market observers, the current environment provides a fascinating case study in commodity market dynamics, geopolitical resource competition, and the intersection of industrial and monetary demand for a critical material. The dual nature of silver as both an indispensable industrial input and a monetary asset creates unique market dynamics that are now playing out in real time. Understanding the fundamental drivers behind this historic move, the technical structure of the market, the geopolitical context, and the genuine supply constraints provides essential context for anyone seeking to comprehend what is unfolding in the silver market. As always, this presentation is intended for educational purposes, providing an observational analysis of current market conditions based on available information and market data. The silver market remains dynamic and subject to rapid changes based on new developments. Each individual must conduct their own research and make determinations about how these market conditions relate to their personal situation and investment goals. Thank you for your attention to today's silver market update. The events unfolding in silver markets are truly historic, and careful monitoring of supply dynamics, geopolitical developments, industrial demand trends, and monetary policy will be essential for understanding where this extraordinary rally may lead. Continue to follow developments across all the dimensions we've discussed, and may your analysis be thorough and your understanding of this complex and rapidly evolving market remain well informed.